following is a presentation of TFNN. The Trader's Edge with Steve Rhodes. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. The Trader's Edge. Now, Steve Rhodes.
Good afternoon from TFNN. Welcome to the March 8th wonderful Wednesday edition of today's Trader's Edge Show. I'm your host, Stevie Perseverance Rhodes, who absolutely knows that each of us should always be pioneers of our future versus prisoners of our past. Hope everyone out there is having a great day. Let's make sure we have an extraordinary one. And of course, the easiest way to do that, it's to always remember that life happens for us, not to us. That's right. When you and I make that one little 2x4 shift, it means we can find the gift in every set of circumstance that life is going to toss at us. Today, you and I, we're going to go check out the circumstance of these markets. We're going to go figure out what the bulls and the bears, what the buyers and the sellers are communicating to you and I just past 1 o'clock in the afternoon. I want you to know that I'm absolutely grateful for your presence here. And more importantly, I'm here to serve you. So feel free to reach out to me. Give us a call at 877-927-6648. We'd love to hear from you. You can always send me an email, steve@tfnn.com, as Mike in Portland did just a few minutes ago. And, of course, inside the Tiger's Den, any ping will do. So let's go ahead and get this show started on wonderful Wednesday. Of course, this is Tiger Financial News Network. I'm Steve Rhodes. Welcome to the show. Right now, we have the Dow trading off 17 points at 20,907. S&P is flat. She's trading at 2369. NDX 100 up 17 points, as well as a NASDAQ composite. Russell 2000 is flat, trading at 1374. Semiconductors are up. New York Stock Exchange down 19 points, but has a problem with its advanced decline data. Or maybe not. Could be just like Paul Revere riding through the streets, only in this case riding through the charts of the New York Stock Exchange. Gold is back $7. Silver's down 27 cents. That's about 1.5% to the downside. Leading the charge here, dollar-wise, the upside, you've got Children's Place. PLCE is the ticker symbol, up 17% or $17. Priceline up $10. Regeneron Pharmaceuticals up 9. Global Blood Therapeutics up $7 and change. Adidas is up $7. Intercept Pharmaceuticals up 5. John Bean Technologies, don't recall ever looking at that chart. JBT, that's probably for JB in the Tiger's Den. That's trading up 6.5 for $5. To the downside, you've got Equinix, EQIX, up $9. That's 2.5%. You've got the Gusher. You like Gushers? Don't think I've ever had one. Doesn't actually sound like a great candy to me. I do know the kids like those Gushers. Well, GUSH happens to be the Direction Daily S&P. I'm guessing that's crude. Is that crude? Yeah, S&P Oil Services. That's trading down 9%, $6.84 out here. Light sweet crude back $2 right now, trading at 51.17. You've got Barrett Business, BBSI off $6. Resolute Energy. Is this Resolute to the downside off 11% or $4 and change out here. Pioneer Natural Resources off a couple of percent or $4. So plenty to look at. But I want to look at what you want to look at, and I don't have a clue what that is. However, I do have one clue, and that's for Mike in Portland, Oregon. Mike would like to go ahead and take a look at ticker symbol OCLR. So let's go look at this for him. Mike says, not sure if I've covered Claro recently, but if you have time during the show today, I always appreciate viewing daily, weekly market profile lines as well as any of your thoughts. Okay, so let's go give that data, that information to Mike. So, Mike, if you're watching this on Tiger TV, of course you are because you sent in that email. Here are your daily and weekly market profile numbers. Now, the daily are the ones in blue. The weekly are the ones in green. All you have to do is look at my data box. It'll say top, center, and bottom. So then you'll know what levels you're looking for. It'll show W for weekly, D for daily. So you've got that information. What we know about Claro, or something like that, we do know that there was a brand new daily profile that formed for you a couple of days ago, 1, 2, 3, 4 days ago. Daily box forming below the prior daily box, not necessarily great. The configuration of that box, though, is somewhat bullish, and that was forming right at the top of the weekly box. So this says that Claro ought to have support. I do say ought to because I'm not sure if it's going to, at 878. This could be an A to B equals CD to the downside, the way the price came off of the high out here. However, and when I say came off, 21 million shares after making a high with 9 million shares the prior day. So this looks like, to me, an A to B equals CD to the downside. It's going to have to get through these levels of support out here, and it's possible that the bottom of the box, 758, will hold, or I would say more likely you would end up seeing a spike down into the 713 area. That 713 area is going to come back and take a look at testing the October 27th swing point out there. Now, let's go to my other charting system. Let's go see what it says. This is one where we can easily take a look at wave counts, price relative strength divergence patterns, and so forth. So off that swing point that we mentioned here, that's where I would just start my counts to the upside. I'm going to do that. That is right here. I think that's October the 27th or 28th. Hey, voila. Look what we have here as it was making its high. Hey, I don't make this stuff up. I just go ahead and post them. And you know that what we love to watch for are those seventh wave moves, just one element of the Chapman wave. And it's a small element of it. It's not even used the way that Basil would teach this to you. Now, it may be, but I'm not looking at those techniques. Here's what we just know. When you get to wave number 7, the old seventh inning stretch out there, it says market may be getting ready to sit back down, just like they'll ask you as the baseball season starts, which, of course, in Florida, it has already started with spring training down here. So you get to wave number 7. This thing takes the kibosh to the downside. Now, price is below Stevie's red line. That's that oscillator unchanged line. That says we've got lower price coming at us. So I would suggest, if you are not in this and you're looking to get in this, that you be patient, that you wait, that you really wait to see, hey, what happens on this next test of this swing point from February 28th. 10 million shares. If it's picking up volume as it's passing that, you're going to see an A to B equals CD to the downside. So, Mike, thanks for sending in your request to take a look at Claro Inc. Now to the general markets. What is it, the one thing, as Curly from City Slickers might share with you, what is the one thing that you need to know? Folks, there's going to be a bounce. It may be a bottom, the next bottom in this rising markets out here. And I suggest the reason why is because of this. It is because of the New York Stock Exchange, which is having some trouble this morning. When I say trouble, let me just find the other chart so I don't have to mess with this. If I can find that other chart out here. Here we go. Take a look at the advanced decline oscillator reading. You know, when you get to minus 150, that hair on your chinny chin, but most likely the back of your neck ought to be standing up. And in case of mine, it was standing up so much it became easy to go ahead and, shave off with the razor. I don't like hair on the back of my neck. When it gets down below the collar, you kind of know what I mean. If we take a look at the New York Stock Exchange, you get down to minus 150. That was probably too much information out there, the old TMI. But it is what it is. It just kind of flows. You're down at minus 199. The last time we were down at Agent 99, actually just a little bit lower, back on November 2nd, 2016, it was only a couple days later where the market made a huge bottom. Guess what? The trend is your friend in the New York Stock Exchange getting to an oversold level. You can take a look at my rising green trend line out there. You're going to see one, can I say hell of a? Heck of a? I can say them both. You're going to see one heck of a bounce coming out of here. Steve Rhodes from TFNN. Back to us. Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Steve takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back, folks. So we got a couple of questions that popped up in the den. And I said I had one hell of a bounce that should be coming at us. It's going to be at least a bounce / bottom out here. And then the question was, hey, inside of the NQ specifically, the question was, where is it that it should then bounce to? So the first level that you would be looking at inside the NQ, now this is a weekly chart that we're going to take a look at. It should be the top of the high. I think that was from March the 1st out here. So that's where you would be looking. But what we have up on my screen right now happens to be the weekly chart for the NQ. And the horizontal lines, those are the horizontal trading ranges. Again, what my system does here is it goes back, it takes a look at all the data that I throw into it. In this case here, I'm taking the data back from, when is it? From 1999. I believe is when I've got this data, and it's looking for the largest number of opens and or closes on a weekly basis. That happens to come in, by the way, at the price level of 16.17. There were 31 of them. And then at the 1929 area, there were 20. In any event, this creates these horizontal levels. Now we're going to just go ahead and explode it up, especially when you are above all types of resistance on the left-hand side. That means no price on the left-hand side. This is especially helpful to us to be able to target prices. When you get above a horizontal trading range, let's just take a look at the last time we were there. And the little dotted lines are the midpoints. But back here in January 2017, price got up to the 50-52 level. Very next week, it was kind of a little doji out there. What do we have this week? We've got a little doji in Stevie's window as we speak right now. That means the open and close as we speak are basically at the same price level. You came down, you've tested it. Then the following week, January 23rd, 2017, it was a test and off to the races. The off to the races in this case here actually took you to the next horizontal trading range, not the dotted line, the middle line, which was 52.08. But what I gave to Maria inside the Tigers Den as the next projection, if you clear the highs from March the 1st, the midpoint is what I'd be looking for, 55.20. If it makes the entire range move, 56.76, that can not or should not be ruled out. Now, Mr. Bill, so Maria, that's where I came up with those numbers from, and now each of you have a copy of this chart, and you know it. Now, in the case of Mr. Bill in the Tigers Den, he was asking if I could go ahead and take a look at the advanced decline data, the minus 150 levels. Remember, it's at when you get to the minus 150, that's where you start looking for this oversold or bottom bounce to form. Now, the beauty about this chart and where we're at right now, inside of the New York Stock Exchange, we have not even broken its rising trend line, the one coming off of the November lows out here. So this one is a thing of beauty. That's why I say, in this case here, we should see one hell of a move. Because we still have a rising trend that's in. We have not even broken that in the New York Stock Exchange, of all things. Now, you'll see some green lines on my screen out here. Those green lines happen to correlate to when you get down into the minus 150 area. But Mr. Bill wanted to go back in time. He wanted to reminisce. You'll see a lot of examples. We're only in 2015 out here, and you see, you want to talk about an indicator that's worth its weight in Goldilocks out here. Well, this is certainly one of them. But we want to go ahead and take a ride back in time. We want to go back to the 2007, 2008 time frame. Well, son of a gun, Mr. Bill, we're here. If we take a look at the high inside of the New York Stock Exchange, October 11, 2007, that was it. Kaput, done. There was a little bit of a test of that swing point, in essence, back in October 31st of 2007. But when we take a look at the first time down, which you'd have to say this would be the first time down if we're going to repeat 2007 now. I don't think we are. In fact, I know that we are not out there, not even close. No cigar. But even if we were, even if you had the outlook that we were, first time down, it got down to reading below minus 150. I can put my data box on to give you the exact number. I mean, what the heck out here? As long as I'm giving the information, I might as well give you the information. It got down to a minus 183. I think we're at minus 200 or so today, are we not? Yes. How about the next time that price got down there? It got down to minus 252. So can it go lower? Oh, can it get below minus 150? Absolutely. I never said that it couldn't. In fact, I said the more that it goes down, there's a good chance the more that we're going to see the triple Lundy, the real springboard out here. That was not the case on November 13th, 2007. You did get like about a 2-day bounce out there. We can see that price got down there, or that oscillator reading got down here in November 23rd. That was down at, what was it, down at about minus 245. That set up a nice bounce to the upside. So even in we'll call, because we know that the 2007 top out here in October was the beginning of a bear market. We didn't know it at the time, but we certainly know it now. We go back and say, even in bear markets, for those of you that have signed up for that, and if you have, please keep your stops in place out there, because this ain't no bear. But if you do believe that it is, even in bear markets out here, you get down to that minus 150 level, you're going to see a bounce. Just expect it. This is the one power that you and I have. We have many powers that we share, but there is one power that gives you the edge. One power, and that is called pattern recognition. It works this way in everything. In fact, I had a question that came in and said, hey, at one time I did a workshop on the psychology of trading, and the question was, how come I don't talk about the psychology of trading during my show out here? And that was actually an excellent question. And what I'll try to do is talk about some of those elements in the very last segment. The last segment of the show is about 4 minutes out there. As long as I don't have a caller on there, I'll talk about, because the psychology of trading is really about the psychology of life. This is about the emotions. When we take a look at the stock market, of buyers and sellers out here, we have to go measure those emotions. This tool that you and I are looking with regard to advanced decline data, getting down to a level, we like to use that base amount as minus 150. We can see that in bear markets, it works the same as in bull markets. Now, does it work all the time? No. This gives you an edge. How good of an edge? I said hell of earlier. Can I say a damn good edge? I mean, it's an edge that if you decide to ignore at your own risk and peril out here. Even in the nasty bear market that was out here, we can take a look at getting down. This just got down to minus 138, 133 back in January of 2008. Yeah, a nice little bounce out there. That doesn't mean again, use stops. Take a look at when you get down to minus 278 back in March of 2000. You're kind of getting the picture out here. These are important levels, and one can say, you fast forward to today, you can say, hey, guess what, Steve? We have hardly moved off of the highs inside the New York Stock Exchange, and yet you're telling me that we are in an oversold condition? No, I am not telling you that. This indicator is telling you that. This indicator is so good, as I say, ignore it if you want. Moi, will not be ignoring it. There is just too much data to ignore it. And we have a nice rising trend line. This rising trend line holds. You can expect that you're going to get one heck of a, and I this time went with a heck of a nice bounce out there inside of the New York Stock Exchange. That ought to take all the other indices to the back to their upper range, or at least some nice retracement thereof out there. Okay, so I hope that answers those questions, and it's just the data. It is just the facts. Now, how about some of the other facts? You know, one of the things that I don't tolerate is the folks on the media channels that dole out just crap. Can I just say crap as well? Just crap of information. They want to scare the heck out of you. That is the only way for them to get you to tune in. You don't have to tune in. I know, look, I value your time. That's why I'm grateful for your presence here. Time is the only thing that we have in common with each other. We have enough. We'll be right back.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. As I was saying when we were going into the break, there's one thing that you and I, each of us share. Each of us are equal in relationship to this each and every day that we wake. And that is the amount of time that we have. The difference between success and failure, many people will call them, might say it has to do with resources. No, the one resource that we share is time. It's just with regard to how resourceful we are with regard to that time, right? It's not the resource. That's about how to be more resourceful. So the reason I'm always grateful for your presence here is I know that your choice, your decision as to where you spend your time is important to you. You know, and if you're here, I want to provide you with the absolute best information I can, and it is with the intent of providing you with information so that you can make a decision. It may not be the same decision that I make. That's cool. That's what makes a market with regard to buyers and sellers out here. All I want you to do is, and I know that you're doing that. If you're here listening to a different view. Maybe it's the same view. Maybe you're just looking for a confirming view. But I will tell you that it is the view that I see as of right now. And I will change that view. If there's any one thing I have learned about trading and investing, it is change your view when the market reveals new information to you. So that being said, Tom writes in and says, hey, good afternoon, Steve. I'm wondering if you think this is a good entry point to get into DGAZ, trading off of the UNG out here. So let's go answer that question. Now, if we were just going to take a look at DGAZ, right? This happens to be the 3-time inverse natural gas exchange traded note out here. So if we're going to take a look at it and ignore the natural gas contract out here, we would come up with the answer for you, Tom, that says yes. I don't think that's the correct answer, but I will give you the information on DGAZ. Why would I say yes? I would say yes because this is pulled back to the top of a weekly TAS market profile and, in essence, the bottom of a daily box that has been out here for a couple of weeks. You'll see in the data box out here that says that is a price level of about 504. So 504 to 509, that should be good support out here. So if you're looking for a good entry point and you believe natural gas is going to go to the downside, then your answer is yes. Now, is that the camp that you and I should be in? I don't know. Let's go take a look at it. And let's take a look at it by actually looking at the current contract that is being traded, and really see what it says, because this is going to provide us, it usually does, with different information out here. If we take a look at natural gas, here is where trying to be short natural gas would be the right reason and what you want to look for. There was a downdraft. Remember, gaps are our friend. So when we take a look at the natural gas contract out here, we will see that there was a gap to the downside, a wide-ranging bar, and that took place on the trading session of February 21st. So right now, what Tom is looking at is price has come back to test that resistance zone. And it is resistance as we speak right now, 2.951. The problem is, and in fact, it may be up against resistance. You're having a good day today. If I just actually put in the UNG just to go ahead and take a look at a volume metric as of 133, that volume metric is looking at about 38 million shares versus today a bounce of 11 million shares. But volume is not the end all to be all. It is just one element of the chair that you and I take a look at. Momentum, and I do mean momentum, and you've got 3.7% to the upside. Nice wide-ranging bar out here today. And what we can also see is that with regard to where this is trading, it is back inside a daily profile. Now, we use those market profiles to answer your question about the UNG. So we should take a look at these market profiles to take a look at what's going on inside of natural gas. If this closes above the bottom of the box today, $2.91, I would say, hey, hold on a minute here. You may have information that says that where the natural gas contract wants to actually trade up to is $3.09, maybe even $3.15. You say, can't be. No way, Jose. And I would say, not so fast. Why? Because if we just turn off price and we just take a look at those market profiles, you tell me on a weekly basis if this has a bias to the upside or to the downside. To the upside big time. Why? Because that point of control much lower to the bottom of the box. That says that if this thing gets above your resistance zone out there, it is going to head to $3.15, and that would be the time where you would go ahead and entertain getting into DGAZ. So it's up against resistance. I don't know if this is the trade to take. Wait for this thing to prove itself out to you for the end of the day. So that was for Tom. Thanks for writing in. Much appreciated, my friend. Let me see if there's anything else out here. There's not. So let's take a look at the bigger picture out here. One of the things that upsets me about some of the garbage that is shared, because you know what? you and I have lots of friends and family that maybe have time to tune into, some Bloomberg, Fox Business News, CNBC, and they get their information. Maybe they read stuff from David Tepper, and others out there. And you know what? What I like to do is just simply turn that noise off. And let's go take a look at the noise, for example, on the charts out here. In other words, there is a perception, there is a belief that this market is going to crater because the Federal Reserve is going to go ahead and raise interest rates. Is there anybody out there that believes that the Federal Reserve is not going to raise interest rates? Isn't the question, is it going to be 1 time, 2 times, 3 times? I say it's going to be lots of times. What if it were going to be lots of times over the course of the next few years out here with regard to the raising of interest rates? Everybody believes that things are just simply going to crater. Is that a real founded comment out there? I mean, where does that come from? Now, look, I wish we had lots and lots and lots of sample points in order to be able to take a look at this. But what we do have is what we have. So let's go take a look at it. Let's take a ride on the reading. Let's go read the stock charts. This stock chart here that you and I are looking at, is this the one that we want to look at? Monthly chart. Yeah, let's go ahead and do it anyways. This stock chart here, because actually I can tie all this together for you. This stock chart here, I'm going to show the 13-week Treasury yield, just so that we can take a look at rising interest rates. So the Fed is going to, start raising the short-term interest rates. It's going to roll over into at least the 13-week rates out here, and we can go ahead and take a look at now the center part of this chart here, monthly chart, by the way. So you're not going to see the noise. We'll go take a look at the noise here, but I want you to get the long-term picture correct. S&P 500 is the middle chart. The U.S. dollar index is the bottom chart. Let's come back to the U.S. dollar index. I mean, so much that we'll come back to it. I'm going to actually go ahead and turn it off for the moment out here because I don't want to cloud your judgment. Look at other times when interest rates have risen. You can go back here to 1992. Okay, from 1992 in the August timeframe into February 1995. Did the S&P 500 crater, for goodness sakes? The answer is, are you kidding me? Of course not. Rates go up in 1998 into the 2000 timeframe. 2000 marked a high out there. But nonetheless, between 98 and 2000, did the S&P 500 go down because rates were moving higher? Are you kidding me? How about from the time period here? And this is a big one, right? So here we've got from 2003 really until 2006, where you had rates going up how often? Yeah, you had rates going up basically every quarter, knocking on the door. We may be in that time period now. Now, did the S&P 500 crater, for goodness sakes? Did it, folks? The answer is no, it did not. Now, let's go take a look at the U.S. dollar index. Rates were going up. People believe the U.S. dollar index is going to get stronger. Did that happen in 2003 to 2007? I don't think so. Steve Rhodes with TFNN. Be right back.
Are China A shares hot or not? If you trade China A shares, now may be time to take a closer look. Trade CHAU or CHAD, Directions Daily CSI 300 China A share bull and bear ETFs. China A shares in either direction. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry, powered by the acclaimed with TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Welcome back, folks. So what we're doing is we're taking a look at interest rates, right, which we know are going to rise. The belief out there that as soon as that starts taking place, that this market is going to crater. I hear time and time again from folks out there, big name people, that is what to expect, or just simply trying to put out there the fear that that is what is likely to happen. Now, we took a look at the monthly aspect of this. You and I have done this before, but it's always good to revisit it just to get our head wrapped around over the long haul, especially since the majority of people that actually listen in, 70% of those folks are really just dealing with their long-term retirement accounts out there. And I do not want you to get the heebie-jeebies, to get scared. Because the reality is, are rising interest rates good or bad for the stock market? Long-term, they are good for the stock market. And you know what, folks? The data proves it to you. This is not about Steve Rhodes going ahead and proving it. This is not my belief system. This is about the reality of the way that the market responds. Now, the cool thing is, for those of you that have powder, in knowing this, there are these short-term impacts, often, not always, when rates start moving higher where you see the market go ahead and sell off. Is that a buying opportunity or a selling opportunity? Well, it could be both, right? Depending on the type of trader that you are. But with regard to long-term money, it becomes a buying opportunity. If you are a swing type trader, you're swinging for the fences out here, it can be both. You can go both ways. Look, the last time, and I believe that the time frame that we may be in this time, we may be, I don't know for sure, but most people believe that this is not going to be in March 15th, March 15th and 16th, I believe, is right? 15th, and we ought to get this date correct out here. That this is not going to be the only time rates are going to rise. The Fed is going to increase rates out here. They're going to do it 2 or 3 times this year, then 3 or 4 times next year, and so on. So I think that we are in a time period that would be similar going back to 2003 out here, 2004. If we take a look at, I believe that the first time that the rates increased, yeah, they did, was in June of 2004. I believe that the exact date was June 30th, 2004. You don't have to believe me, go back and take a look at it historically. Now, the top line out here happens to be the 13-week Treasury yield. You can see that thing was just simply on a tear, lower left to upper right. So we know that rates in the market were certainly, regardless of what the Fed was doing, rates here, short-term rates were moving higher. Just simply going lower left to upper right out here. Now, it happened to be the rate went from 1% up to 1.25%. And let me tell you, the market reaction. So if you're looking for a short-term top out here and that big bounce that we should get because of the oversold condition inside the New York Stock Exchange, and today is what? March the 6th, 7th, 8th? Pretty good chance that when that does happen, you should see the market move higher into the 15th, if it's the 15th or 16th, 14th, 15th, 16th out here. It may just be a few days, but it should be one heck of a bounce out here. Then And I don't know this for a fact, but there are enough topping patterns in the market, unless those are taken out, to suggest that we ought to see a pretty good negative response in the marketplace. I don't want you to buy into the concept that that's it. Adios, amigos. We are headed lower. I want you to take a look at that as being the next buying opportunity when that. Now, that may not come in until April. April 7th was my target date. That day now is probably going to shift with regard to some pattern that might be out here. But if you take a look at back in 2004, as rates went up from 1 to 1.25, and then every meeting thereafter, look, back here on the trading day of August 11, 2004, the next time the Fed raised rates from 1.25 to 1.5, that was near the lows out here. It was very close to the actual low inside of the S&P 500. In fact, during that entire process of moving higher between 2004 and the last time, the last rate increase was back here on June 30th, that was the bottom, right? The second time around. Maybe that is, in fact, what we're looking at here. I don't know. But I will tell you that rising rates out here are overall, longer term, good for the market. What you want to do is be looking for patterns. On this chart here, you can see each of the different quarter point raises in rates. So between June of 2004 and then the last time that the Fed increased rates, which was to 5.25% back on June 29, 2006. So 2 years worth of increasing rates. And that is very likely the condition that we are in now out here. It ended up being good for the market. You may say, how good? Well, the how good was the S&P went from 1141 to 1273. You might think in 2 years that's not much of a move. Well, turned out to be 12%. So could this time be the same, where in 2 years we see another 12%? Yeah, of course. And what's wrong with 6% per year? Let's not get too hung up into this. Let's just simply understand that raising rates out here has not been a bad thing for the market. In fact, if you take a look at when the Fed began reducing rates out here, just the opposite, they began reducing rates back on the trading day of September 20th, 2006. It went from 5.25 to 4.75, 0.5% move. They were not done. Now, the market did respond nicely, right? Went up into the high of 2007. But quite frankly, folks, by the time that they were done reducing rates from 5.25 all the way down to, what was it, 0.25%, 0.5%? I think that was in September. That was September. It was 0.25%. Was September 18th, 2007. The stock market, even though it had gone higher into the highs of 2007, had actually lost 28%. Right? So if you're just going to take a look at from reducing rates, and let's not get too hung up into this, but reducing rates was actually worse when it was all said and done for the markets versus raising rates out here. So do not buy into that BS that is played on the boob tube out here. It just isn't real. But now it's all information before you had this from Steve. That's the best BS that is out there, all before Steve, and thank you for reminding me about that, Mr. Z. Now, here is the remember we went back and we were taking a look at this chart here with regard to the U.S. dollar index. If you go back to that same time period with rates rising from 2003 to 2006 out here, what was happening with the U.S. dollar index? How many times have you heard that rates are going to go up and the U.S. dollar index is going to go up as well? I mean, you hear it like all the time. Are you kidding me? Now, not that it can't happen. But then, and this is how I put together the bigger picture out here. What is the bigger picture, you say? The bigger picture is taking a look at this out here. Taking a look at, so, days like today are great to be able to do this, right? Because we can come back to it. Where is that chart out here? Where is that chart? Where is it? The U.S. dollar index. Oh, don't tell me I can't find it. Where is it? I know I can find it. Where is it? Oh, it's right here. Thank you. Okay. Let's take a look at, let's put ourselves into the 2003 time frame out here. Here's the U.S. dollar. No, let's put ourselves into today's time frame. I take a look every weekend at the commitment of traders data, and I like to look at what the large commercial traders are doing. In this case here, we're looking at the U.S. dollar index. That is the bottom portion of my screen. If we take a look at what their holdings are as a percentage of open interest, they are at one of the highest rates, not the highest rate actually that they were at and taking a look at like this was back in August of 2015. And they were just a smidgen higher than where we're at today, 77.6%. Now, back then when they were up at that that level. Did the U.S. dollar index move lower? Yeah, it did for several weeks out here before it found a bottom. Folks, I can take you back here. You'll see here, this is the data we have goes back to 2006. You can see we're up at the highest rate levels. Now, all price is doing on this bounce is testing Stevie's red line. We're really pretty much right on it. It's been a counter trend move. Hey, look at that. Wave number G up at the high out here, wave number 7. Commercial traders are betting the U.S. dollar index is headed lower. Think 2003, my friends. Steve Rhodes with TFNN.
If you're looking to unearth a new financial resource and diversify your financial portfolio, consider the new market-safe core commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 4 equally weighted commodities: gold, copper, WTI oil, and sugar, in one powerful CD. With no pricing caps, you can potentially earn an unlimited upside payment at maturity if the commodities increase in value across semi-annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There's no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. With certain commodities on the rebound, now is the time to take advantage. The March 23rd funding deadline will be here before you know it. So call 1-855-750-4051 or visit everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once more, that's 1-855-750-4051 or visit everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
TFNN has just launched a special event in Tampa with Tom O'Brien taking place March 18th, sponsored by Nadex. Tom O'Brien will be presenting 2 workshops for a combined 2.5 hours of education, bisecting and dissecting his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System. March 18th kicks off with a continental breakfast as we get everyone checked in, and that is followed by 2 75-minute workshops with Tom O'Brien. The first workshop from 8:45 until 10 a.m. will cover quality volume, cause and effect, and ABC structures, and the second workshop from 10:15 until 11:30 a.m. will cover swing points, testing, and the Tiger Gartley. Tom will then wrap things up with a question and answer session, which will be followed by a Tiger Luncheon Social on the rooftop of the Westin Hotel. The best part is that it's all free, but you must register to attend. Visit the front page of TFNN.com for all the details and to sign up today, and we hope to see you in Tampa on March 18th.
TFNN has put together the finest live programming lineup each trading day, featuring some of the most knowledgeable and respected financial minds in the nation to educate traders and investors. On Mondays, Wednesdays, and Fridays, we broadcast 9 hours a day starting at 8 a.m. as John Logan kicks us off each trading day with the Global Market Pulse. Tuesdays and Thursdays, we broadcast 11 hours. Get an early and healthy start to your day as Nico and Paige bring you Living a Primal Lifestyle. Then catch Andy Hecht at 5 p.m. with the Commodities Hour, following the Tom O'Brien Show. Mondays and Fridays, catch live trading on the Nadex platform with host Tom and Tommy O'Brien, along with Daryl Martin on the Bull Bear Binary Option Hour. See the TFNN program lineup via the link on the front page of TFNN.com to get a complete overview of our TFNN shows and hosts, and keep TFNN's Tiger TV tuned in on your mobile device, PC, or Mac for the latest financial news and information throughout the broadcasting day. TFNN, educating investors. Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
Welcome back, folks. So what we learned is from 2003 to 2006, as interest rates were moving higher, it was really 2004 to 2006, as interest rates were moving higher, we saw a time period here where the U.S. dollar index was actually moving lower. Totally opposite than what most are going to tell you about out here. And when you go ahead and you put that together with this commitment of traders data, when you take a look at what the big money traders are actually doing, you can understand why they have, or maybe can't understand, or maybe I couldn't understand, but now I can understand why it is that they have been actually moving to very large net short positions. Of course, you and I know by taking a look at these different seventh wave patterns out here, which is how the markets usually top or bottom. And in most of the indices, not all, but most of the indices, we are in that seventh wave move, which would then also suggest to you and I that to anticipate that first move come the 16th, that the market ought to go ahead and sell off. But don't jump on that short train for too long out here. And if you're a long-term trader, really don't worry about it. because this is better for you than it is. If this is better for you in a rising rate environment. Now, think about that with regard to gold and if the U.S. dollar index is actually moving lower. Because this actually, there was a question that came in during the week, I think it was, or last week. Can we see an A to B equals CD to the downside? And the answer is we absolutely can. Has it formed just yet? I don't know. But can we see it? Absolutely. And I've just laid out the facts. I've just laid out the data for you. So, it has a lot of implications. If, in fact, the U.S. dollar index is headed lower, what will happen with regard to light sweet crude? Even though it's getting hammered today, it is down 4%, $2 as we speak right now. And pretty amazing, actually. You've got the S&P is up a point, and light sweet crude is down pretty big. Don't forget that correlation exists out there as well. Now, John in Sarasota, we've got 2 minutes left out here, so we didn't get into the psychology of trading. But we did get into the psychology of the markets in one sense, and not necessarily believing everything that you hear out here. Go chart it. Go do the work yourself, or just continue to listen and hear it. We'll keep you on the right side, or at least give you the information so you can make a decision. John here from Sarasota wants us to take a look at ticker symbol NYRT. Now, as we take a look at NYRT, let's go ahead and look at it on the big screen out here. Here's what we know. This, by the way, is the New York REIT out here, Real Estate Investment Trust. John, the question was, do you see an extended upturn? This certainly does. It has been going from lower left to upper right. So you see a nice trend that is in place out here. So that looks good. But with regard to what is it doing right here, right now, it's testing an important level of support. That important level of support is the bottom of its daily box out here. If this thing starts to crack below 983, moves below 983, today's volume 1.1 million share. Last time we were down here was 3.9 million shares. So it's coming back on light volume. But if it does get below or close below 983, this is going to get back and it's going to likely test the low from January 5th, and that is about $9.57 out here. You are also, or this is, maybe not you, but this is also the critical point in its phase out here. And the reason why it's critical is we can see on this chart here that the price oscillator, the bottom panel of our screen, is at zero. You can see Stevie's red, green, and blue lines, how they've come together here. And today is actually a bearish view on NYRT. Why? Because just as we're getting that convergence, prices come and tested it and rejected it. It's signaling, John, to you and I, that this is going to go ahead and bust through that zero line on the price oscillator. And there is nothing more bearish than a falling price oscillator below zero. If it moves above it, different outlook. But let's just go with the information that we have right now. It looks like that daily profile is going to be taken out. Well, folks, thanks so much for joining us here. Stay tuned. Your favorite polar bear in mind, David White, he's up next because it's Wonderful Wednesday. You got the Tom O'Brien show after, but I think that's going to be hosted by Basil Chapman and by John Logan. So you're going to have 2 great hours. Have a great Wednesday. We'll see you on terrific Thursday. Take care, folks.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
You're watching Tiger TV.